Good morning, everybody. Kirk Spano. It is Saturday, March 19th, and I am back from Arizona. Had a nice 2-week vacation and got very little work done as you would think it, but I read a lot. And I talked to some pretty high-end, powerful people, including a couple hedge fund managers that I know, several people at Intel, because I went and visited Intel. You saw some of the pictures on that already, and a biotech analyst. So we have a lot to talk about over the next several weeks, but I'm going to start with this headline. The Fed did not cause inflation, therefore cannot fix it without destroying demand and causing a recession. That is important to think about, and I'll get to that in just a minute. When I manage money, what I'm really looking for is people who can wait a few years for good things to happen, as I typically buy stocks when the stock market herd hates what I like. I am seeking to find growth at value prices and valuable assets that the market does not assign value to. And here's where I would say that sometimes you need to just shut up and listen to me, because I know there's a lot of people who read a lot of things and they gloss over a lot of different content, and the narratives are confusing, and the logical trains of thought seem to be valid until you find those 2 or 3 weak points in the logic chain and go, well, what about this? What about that? So I'm going to talk to you about a couple of logical things today that I need you to follow along with, because they're probably right. And I say probably right because nobody knows absolutely. I don't. I just have a history of being mostly right most of the time. It's not all the time. It's not all the way, but it's pretty darn close almost every time. And the fact that I'm ahead of the markets by 2 or 3 years sometimes has good and bad. The good is I usually get prices way lower than anybody else. The bad is that sometimes they chop around way lower for a while. And in the last couple of years, I've really gone back to supercharging my technical analysis, which some of you, not really you, but probably some of the people who have left, they don't like. They just want a fundamental story. Tell me a story. And I'm a really good storyteller. I've got a couple novels in development, screenplays. I've written short stories. I've written poetry. I've written things that 2 different teachers, one in high school and one in college, said, I don't know if this is amazing or if I just don't understand it. And they both gave me C's. And yet here I am, the professional writer. My guess is that they just didn't understand it, because they probably were teaching something to students, at least a few, who were better than them. And what I'm going to tell you right now is going to sound like it's prideful, but it's not. In my life, I believe in being proud, but not prideful. I'm a very big Bob Uecker guy. Humility, right? Self-depreciation. Have a sense of humor. Except that in your pursuit of perfection, that you'll never get there. But then along the way, you can be excellent. Does anybody know whose quote that is? Some guy named Vince Lombardi. So I throw in all the Brewers and Packers guys when I can. What I'm going to tell you is that when you read these people on Seeking Alpha or Investor Place or anywhere else, I want you to ask yourself a question. Are they talking to you because they've made money and they have the freedom to do it? Or are they trying to generate a paycheck? So I'll tell you, if you're at Fundamental Trends, you're getting a service that other people offer for between $1,000 and $2,500 a year, for around $300 a year after discounts for most of you, at least in the first year, $600 after that, right? And if you're at Margin of Safety, you can see that there are services just right on Seeking Alpha that are way more expensive. And I'm telling you, their track records aren't as good. Now, that doesn't mean I don't make mistakes. I do. And I have a hard time explaining sometimes why I do the things I do and what I consider relative performance to be. To me, relative performance is the bottom line. So when I get chastised for missing the energy trade, I say, well, but I got into alternative energy, which went up more. Yeah, but you didn't buy Occidental again, or you didn't buy Conoco again, or you didn't buy Exxon, or you don't like Exxon. Yeah, but I bought some stocks at $5 and $6 a share that are 20 now. And I bought other stocks at single digits that are over 100 now. Granted, I didn't hold them all the way up there sometimes, because again, I manage other people's money. I have to be more conservative than most of you. And that's where you have an edge. You can define your risk tolerance better than anybody else can. And you can make decisions that I have to err on the side of caution. Sometimes I don't actually do that. I should, The regulator would get mad if somebody complained during the down year. But again, I've purged my firm of those types of clients. I want you to accept that most of the people that you read are not making their money investing. I did. At 45 years old, just shy of my 46th birthday, I basically decided to take a gap year. I saw that Lloyd Blankstein said that in the press the other day. I'm a former CEO who's taking a gap year. I guess that's kind of what I did. Didn't really work in 2016, hardly at all, other than winding down my business a little bit. Then in 2017, having a market watch had ended at the end of 2015, early 2016 as well, because they shut down a portion of the paper that I wrote in. I jumped over to Seeking Alpha, started winding it up a little bit at a time. And now I have templates and I have a new spreadsheet that I'm going to unleash on you for the second quarter. It's going to make it really easy to follow the trades. I just want you to stick with me here because you saw in the last few weeks, some of our stocks that we bought on the way down here in the last year start to do pretty well. And now all we have to do is get out of this macro mess, which might take the rest of the year. And a lot's going to depend on the Fed. And I think that we are at a point here that a number of big things are going to happen. And I haven't written the article yet, but what I really believe is about to happen is what I would call the big divergence or the great divergence. What do I mean by that? I've used the word bifurcation before. I believe that the old man stocks are on the verge of getting crushed again. This time, there won't be a Fed bailout for them. So all those old man stocks that I told you in 2018 and 19 to sell, they got crushed by COVID, only to be bailed out by the Fed. The next time they fall, you better get a panic button because they ain't getting up. So let's talk about the Fed. The Fed did not cause inflation. Therefore, they cannot fix it without destroying demand and causing a recession. Why do I say that? Why do I say the Fed did not cause inflation? Well, because we know a couple of things. All right. So let's just think about our 4-step investment process before we get started. We want to identify the strongest secular trends. Try our best to understand government and central bank policy. And I will tell you, there's a lot of reading between the lines you have to do. And there's one underlying premise that you should always remember. It's all about the dollar. It is all about the dollar. Repeat after me. It is all about the dollar. Keeping the dollar the reserve currency. Once we've identified the trends and understand what government and central banks are doing, particularly the Fed, we dig into the industry and company fundamentals, and then we apply technical and quantitative price analysis. And here I'll just point out, there is a difference between technical and quantitative price analysis. Technicals are, I call data light, depend on pictures and people drawing arbitrary lines. Shooter is our resident Elliott Wave analyst, but I will tell you, he adds a lot more data and overlays to the Elliott Wave and uses that AI of his. He is probably the closest I have found, and I don't even know if he'd call himself this, but he's kind of like a quant light guy, overlaying Elliott Wave analysis. And that's why if you've been trading with him over at Fundamental Trends, you have made some spectacular trades. And you're tempted to trade more than you should because he's been that good. I'll just urge you, never trade more than 20% of your wealth, ever. Given that bonds suck, in the 80-20 portfolio, 80% equity, 20% bonds, it's kind of what people have been doing for a long time if they're growth investors. I'd say take the bond money, that 20%, and that's all you trade. Why? Because you're recycling the cash in your account, but compounding trade to trade, while leaving your core equity portfolio in place and just position trading that, right? Holding things for quarters or years. And with small cap stocks, you're holding for years, right? So think that through. So where are we with the Fed? Well, we know that some of the yield curves are starting to get close to inverting. This is the 2-year and 10-year and the 5-year and 10-year. Morgan Stanley put this chart out. Bloomberg copied it. And what we see is a 5-year, 10-year curve. The difference between the rates on the 10-year and 5-year treasury are down to basically zero. The 10-year treasury and the 5-year treasury are basically paying the same amount in interest. The 2-year and the 10-year, the spread's only about 25 basis points. So you've got a very, very flat yield curve. And the narrative is that means that we're going to get a recession. But there's more. The scary narrative that they put out there isn't really that scary yet. The best indicator of recessions is the difference between the 3-month bill and the 10-year treasury. And what we can see over here on the right-hand side is it's still about average. It's heading the wrong way. It needs to jitterbug here for a while. So the 3-month is actually fairly similar to the Fed funds rate. We know that the 10-year treasury is about 2%. I could tell you exactly what it was today. So that means that the Fed can push the Fed funds rate into the ones without really triggering recessionary pressures, at least on the monetary side. That still keeps the cost of capital very low for financing and things like that. Even if they raise the Fed funds rate up to about 1.5%, which is what I think is going to happen. Now, if they listen to people like Jim Bianco and some of the other knuckleheads who are trying to tell you that the Fed caused this inflation versus they saved you from a depression that COVID was going to cause. I mean, there's no doubt that COVID was going to cause a depression if the Fed and the government hadn't stepped in the way they did. That's why I was so bearish. It was the biggest financial event in history. Biggest. Nothing else is close. Not the Great Depression, not the tulip bulb crisis, not 1987, not the financial crisis, nothing. The economy had a heart attack in early 2020, and without the interventions that we got, I don't know how bad things would have gotten, but it would have been bad for 2 or 3 years probably, at least, maybe longer. Consider what was going on and how the economy just stopped. The idea that the economy is super strong right now is wrong. Most of the global economy is still in slow growth forever. Why? Because forever is forever. Demographics are destiny. And if you haven't accepted that yet, you're just wrong. And you need to get over yourself. If you don't believe the aging demographics drive everything in economics, go read Neil Kashkari at the Minneapolis Fed. Plenty of stuff out there. You can go and read Harry Dent's material. Not a great forecaster on stocks and investments, but he's got the economics nailed. Demand is driven by demographics. Pretty easy. More people, more demand. More young people having babies, having households, more demand. Well, the population is aging, which means less demand, and there's fewer people as a percentage having babies and starting households. Just is than what it was 20 and 30 and 40 years ago. So when we take a look at this chart, we say, okay, how much room does the Fed have, right? How much room is there for the Fed to avoid a recession? About 1.5 points. Because the long-term interest rate, the 10-year treasury, is going to be between 2 and 3% for a very long time. Ben Bernanke, after he retired, had a meeting with David Einhorn and a bunch of other hedge fund managers who basically wanted to buy information from him. So they all paid him $1 million, something like that. Literally, they all paid him $1 million and had lunch with him. They paid $1 million to have lunch with Ben Bernanke and get some answers. And one of the things he said was, I don't expect interest rates to normalize in my lifetime. Guy was pushing 70 at the time. So he basically foresaw the interest rates back in 2012, whatever it was, we're going to stay low for about 20 years. That roughly coincides with what we talked about a few weeks ago with Tom Lee saying that we were going to get a boom in the 2030s because of the millennials. And that coincides with me telling you that the dollar was just going to get stronger and stronger. So we're in that period now, the 2020s, where I think that half or 60% of the stock market could chop along sideways a very long time, meaning that the S&P 500 could do very poorly for indexers from the recent peak through the end of the decade. Maybe make another 1,000 points, get up to 6,000 by 2028, 29, 30, something in there. Why do I say that? Because there's so many zombie stocks on the S&P 500. Once those bonds that the Fed bought have to be refinanced, if interest rates are going up at some point, we run into the boomer bust. There's a lot of things that go wrong late this decade. I think this decade's going to end up looking a lot like 2000 and 2010, right in there, 2000, 2009. We're going to get another rally. We're going to get another fall. We're going to get another rally. We're going to get another fall. An ending diagonal, maybe, if you are an Elliott wave person. That takes 6, 7, 8 years to happen. And again, I'm not throwing this out there because I made it up. I read a lot of people's research, and this is what I agree with, is the most likely scenario. So we are in a choppy market period, and the old man stocks, as I call them, are the ones that are going to get beat up, and other categories are going to do really, really well. And we need to focus on that top 20% of stocks that I talked about recently. So do I think the Fed is going to cause a recession, right? Will they make a mistake? I doubt it. And the knuckleheads who say that they already did by saving us from a depression, they're just still knuckleheads. So if a knucklehead says the Fed made a mistake by saving you from a depression, how do you feel about that, Jim Bianco? A lot of knuckleheads out there, a lot of flunkies. But they say things in the press that gets them in the press. Why? Because people talk about it. Click, 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 click. Look at our ads. Even Mohammed El-Arian is wrong on this one. The Fed did not make a mistake by not pulling back. Again, the Fed did not cause inflation. I've said that, but I haven't proven it yet. How about I prove it? All right. What did cause inflation then? Higher oil prices. OPEC, basically Saudi Arabia and Russia, held back on oil supply since April of 2020. U.S. oil companies have held back on supply in order to fix their balance sheets. The ones that survived have basically done that. And at the same time, we got the V-shaped recovery in demand for oil, creating about a 1 million barrel per day shortage of oil globally. At the same time, because of COVID, China lockdowns have disrupted production. Semiconductor production has fallen short. It hasn't fallen, it's just short of what the demand increased. So supply for semiconductors went up, but demand for semiconductors went up more. Why? Because the government bailed everything out. The Fed bailed everything out. Demand came back quickly. And then shipping logistics have been disrupted since COVID due to labor shortages and, frankly, gouging. I don't know that gouging is the number one thing. But if you take a look at the profits from shipping companies, why have shipping rates gone up by double and triple, right? It's because there aren't enough shipping companies left because they all got blown up 3 separate times in the last 15 years. Somebody mentions a shipping oligopoly. Yeah, it's true. And I probably should have bought more shipping stocks a couple of years ago. But at this point, I sure don't want them. There's a whole bunch of ships coming online. How do I know that? Remember when I went up to Door County a couple of months ago, watched a Packer game, and I went to a shipping yard in Manitowoc, and I went to another shipping yard in Sturgeon Bay. There's a lot of ships coming online, my friends. So I used a phrase a couple of weeks ago, which was sell the shortage, buy the glut. Why would you sell a shortage? Because prices have already gone up. And high prices are the cure for high prices. Low prices are the cure for low prices, right? Prices are low, supply dries up. Prices are high, you get more supply, right? Simple supply and demand equation, right? As those lines get out of whack, they always pull back towards equilibrium and usually overshoot. So if you remember your Econ 101, if price goes up, that means the supply is going to go up and pull price down, and vice versa. So these are the things that caused inflation. Well, you can say that, Kirk, but how do you know? Oh, Bureau of Labor Statistics, handy dandy chart. This is energy. This is everything else. And energy affects the prices of everything else. Supply chains, food not getting to where it needs to be. Something I've told you about for years is the weak link in the food chain, because there is no shortage of food on the planet. We're just bad at moving it around. So let's focus on energy. What happens if price of energy comes down, right? And how far can it come down? I went and signed up for my favorite data provider again because they brought the price down like 90%. That's something that kind of jumped out at me today. I'll just expound on that a little bit. So I use a data service called Noma, and I had turned it off because the price was like $99 a month or something. It was a lot, and $99 a month. I mean, I have a lot of subscriptions, so because it wasn't easy to use, I had to put a lot of time into it, and I got another AI for data. I got rid of it. Well, the price now, instead of being $1,200 a year, I got it. I think I got it for a sign-up special for a year, but I got it for $30 for the next year. So from $1,200 a year to $30, and they may have changed the tier level a little bit. I might not get certain downloads or something, but I get this. What is this telling us? Well, let's go back to Noma. It means that data is getting cheaper. So we need to keep that in our head for our cash flow models for certain companies. All right, back to oil. Saudi Arabia needs roughly an $80 barrel of oil. Who did you hear say that recently? Eric McAfee from Ametis said that he expected oil to go back down to around $80 a barrel, and then that would be roughly where it would be long term because that's what Saudi Arabia needs to balance their budget through 2030. And it's like anything else, it'll spike up above for certain narratives and it'll drop down below for certain narratives. Here's a narrative that I think you need to understand on oil, right? This is the one that traders want to tell you about. Oh, look, crude oil supplies or inventory. It's at the low end of its 5-year range. Drive the price up. Trade. Click. Here's the real story. Oh, look. We have a lot more oil than we ever did prior to Saudi Arabia flooding the market with oil in 2014 and 15. Narrative, scary. Reality, not so scary. I warn you about narratives all the time. And I warn you about people using short-term charts to push their trade. I'm also going to warn you about this idea that demand for oil is going to keep going up at a fast rate. Let's go all the way back to 2017, so long ago, 5 whole years. Demand for oil, about 97 million barrels per day. 3 years later, right before COVID, it peaked about 102. So they had a growth rate on oil demand of about 2% per year. It had been higher before that. So it was starting to flatten out, something I call the peak oil plateau. And now we're back to peak oil usage, almost there. These curves, these forecasts, they're never perfect. But look what happens in early 2022. Supply exceeds demand. Now let's imagine that this doesn't flatten so much. Let's imagine that this goes like this. But let's also think that maybe supply could go a little bit higher. Well, could that happen? According to the EIA, could. It just could. Because as I've been mentioning to you for 2 months, basically just before this report came out, because I got this data before EIA published it. I just got it from the companies. Companies like Chevron and Exxon and Pioneer and Occidental and Conoco, and I should have put EOG in here, are all adding significant Permian oil production, right? Somebody says supply of oil depends on how Russian oil is treated. No, it doesn't. Not even a little bit. Why do I say that? Because the Russians already signed a deal with China before they invaded Ukraine. They're just going to send their oil to China. They're already building the pipelines. So yeah, could there be a little short-term hiccup? Sure. But even Europe hasn't canceled their contracts through the end of the year. They're just saying we're going to get to it. All we're going to see is a shift in where Russia's oil goes. It's going to go to China. And then China's going to squeeze them on price. Why? Because that's what China does. China says, here, look at this beautiful, beautiful carrot. And then they whack you upside the head with it. I told you the story about the professor I had in like 1991. 92, I don't know, it was early 90s. He said, this is all you need to know about China. That they're going to promise you the moon and the sun and the stars, and you're never going to lift off. They will take your money and make promises to take more of your money. It's what I told you was going to happen with the Chinese stocks. I said at some point they'll get cheap enough, and the Chinese people or the Chinese officials will have bought enough of that stock that they'll make an announcement to drive the stock price back up. But that's exactly what happened. There's just a whole new generation of suckers going to buy those stocks. And you can trade them. You can, but you're not trading technicals there. You're trading the macro factor that the Chinese government is going to either push the stocks up, push the stocks down, just like Saudi Arabia has done with oil. Market manipulation. And if you want to trade things that are in heavily manipulated markets like oil or Chinese stocks, good luck to you. It's pure speculation. Don't think you're smart. It's gambling. If you're a good gambler, gamble. But understand that's what it is. Been watching it since college, 30 years now. Why would it change? They still have autocrats, right? They don't have property rights. They're going to pump it up and dump it. They learned from Boiler Room and The Wolf of Wall Street long before those movies were out. Pump and dump. Oil is pump and dump. China stocks are pump and dump. If you want to participate, go ahead and participate. Understand how it works, though, if you're going to do it. If you're going to try to trade this pump, great. Then understand that the dump is coming and have a exit plan or a short strategy at the back end. Now, are we going to see China stocks go up now for a while? I don't know. Don't really care. If I was going to buy a China stock, the only one I'd buy would be Alibaba because of the cloud. I don't even think I want EMQQ anymore, as I talked about a couple weeks ago. In any case, back to oil again. Little sidebars. Lower 48 new production is going to climb a lot in the next year. One of the things to understand about Occidental, the reason why Warren Buffett is buying and Carl Icahn is selling, and I'm going to write this article because I think it's fascinating, because Warren Buffett won the deal years ago. Carl Icahn is exactly right that Buffett got a sweetheart deal on that debt that they loaned to Occidental to buy Anadarko. What's Occidental? Still $75 billion in debt, but they think they'll get it down to 50 by the end of the year. Suddenly, Buffett is in a position, and the next time the price of oil falls and Occidental needs money, I think Berkshire Hathaway might end up owning Occidental. And Occidental has a couple of things that I think Berkshire Hathaway wants. The main thing being the carbon capture. It's not getting talked a lot about right now. Reason that we're in a metis is because of the carbon capture and the biofuels, mainly the carbon capture. Talk about the biofuels, but the carbon capture gets zero value by the market. Remember what we talked about? I want to buy things that are either growthy at a value price or a valuable asset that nobody recognizes or assigns value to. So I talk about the real estate holdings at Ford or Kohl's, even though I probably should have bought Kohl's. There's a lot of things you could have bought. I actually talked to a Kohl's executive this week because I suggested that they split off, not spin off, but split off a REIT. We'll see what happens. In any case, production of U.S. crude is going to soar in the next year or two because what I told you is going to happen is starting to happen. Oil companies are going to panic pump for a while because they know there's a huge transition to EVs coming in 2026 and 2027. Again, we've talked about this before as well. Why are EVs going to start taking the stage in 2026 and 27? Because the mileage requirements are so high that it is physically impossible for their fleets to meet the standards without selling more EVs than ICE vehicles. So they have to reserve the ICE vehicles for trucks and bigger vehicles. There's going to be almost no, other than some sports cars and some muscle cars and things like that, there's going to be almost no ICE sedans and small vehicles, passenger cars, available for sale by 2030. They're all going to get phased out from 2026 to 2030. I mean, like you said, you'll have a Corvette here and there. You'll have your muscle cars and some of your specialty cars, but you're going to see 80 to 90% of these sedans and passenger vehicles available for sale be EV, and there'll be some hybrids, some hybrid trucks and SUVs. But really, those aren't even that efficient because you usually want to be able to take those long distances, and it doesn't pay to have two sets of drivetrains. People say, well, but I get oil. Big deal. The batteries are getting so good on these cars that in under an hour, all of a sudden you have 300 to 600 more miles of range. And how many of us can drive more than 300 to 600 miles in a day to begin with, right? Not many. And the big trucks we know are starting to go hydrogen. That's just starting. Why do I mention those things? Because we know what's coming means the oil demand is going to stop growing imminently. So in this period from 2022 to 2026, the blue line, which is the line we're on right now, is going to shift to the yellow line, probably right in here somewhere, 2026, 7, 8, right in there. This curve is the net zero scenario, and we're not there yet. So what you have to do with this curve for oil demand is figure out at what point you attach it to the yellow line. I would say that's right around 2030. Why? Again, most of the ICE cars will be gone. Not gone, but the new ones, there won't be new ones for sale. They'll hang around on the road for a long time. But the majority of new cars by 2030 are going to be EVs with a handful of hybrids. And I wrote an article back in 2012 or 13 on MarketWatch. I actually thought it'd be the other way around. I thought the hybrids were going to take over. And as I learned about the engineering involved, I realized it's going to be EVs. Unless you have a big vehicle, it's hard to do two drivetrains and make it efficient. So this green line isn't going to happen from here. It's going to happen from out here. So imagine that we end up on the yellow line and that it's a little bit higher, right? Because we're going to split the difference somehow in here between current and announced. We won't quite get to this and we won't quite get to that. Be in between. And then around 2030, attach this green line. By 2040, we'll be down to 70 million barrels a day of oil. And I've had my chart out there already, that we'll be down to 50 million barrels of oil per day by 2050. And a lot of it is not going to be for transportation. It's going to be for all other things that we use oil for. And who's going to get this down? It's going to be companies like Ametis. And Chevron is actually getting heavy into the biofuels as well. Why? Why biofuels? Everybody thinks ethanol from corn. It's not going to come from corn. It's going to come from all the forests all over the country, orchards all over the country that have to get recycled, and all over the world. Recycling orchards is actually a massive fuel opportunity because the trees captured carbon, and rather than burning them and putting that carbon back into the atmosphere, you can turn them into fuel. It's pretty neat, right? Instead of using oil, you use the trees. That's what Ametis is doing. That is why I pounded on you this week to buy Ametis. So clean energy's future isn't in the future, it's now. Government is driving it. Industry is driving it. Utilities are driving it because they want to get out in front and save themselves. And the technology is here. We are in the process of scaling up production and manufacturing. That's all. And we know that happens within a few years. Ford is building the biggest factory on the planet in Kentucky. I thought Intel was huge in Phoenix. But think about, why would Ford build the biggest plant in the world when they have all that real estate? It's because of the way the EVs are built. Tesla's doing their mega factories too. In Ford's case, it frees up a ton of real estate for other things that they can get into with their fourth industrial revolution technology that we've talked about. So right now, because of what's happening with oil supply and demand and what's happening with technology, if you haven't embraced clean energy yet, you need to, because it's probably going to be the biggest winner over the next decade or 15 years. Again, how do we know? I don't just want to tell you something. I want to prove it to you. I don't pound the table very often. You know that I don't. Look at this curve on renewable energy. Look at coal. Renewables, as of last year, passed coal, right, for electricity generation. Did you know that? I don't think most people did. Passed nuclear. And nuclear actually has a little tick up because they added the one plant. Natural gas is still going up, mainly as a function of coal coming down. What do you think the next curve to turn over is with this one going up? What are renewables going to eat next, right? Renewables are going to eat natural gas starting in the 2030s. So if that's the case, instead of asking me if I should be buying Antero now after it's up a zillion %, you should be looking at an exit strategy, especially since in the next couple of years, you're going to see more U.S. oil production, which means what? More associated natural gas production, right? Yeah. Somebody says if Magnum Hunter would have survived. Yeah. Hey, there's a lot of crooks in the energy industry. Most of them have actually gotten shaken out. Now there's still some idiots, but most of the crooks are gone. I mean, you have your big CEO crooks who, take triple the pay they deserve, but the charlatans, the fly-by-night guys who, show up and then disappear 5 years later, they're mainly gone. It's because the age of the wildcatter is over. Man, there's a handful out there. They find somebody else's bankrupt asset and they can squeeze something out of it. But wildcatters are pretty much done. So planned U.S. utility scale, right? Solar and wind, 70% of it is what the utilities are doing, right? Not long before natural gas gets eaten, 6, 7, 8 years. So sustainability isn't just clean energy, though. It's a lot of other things. More efficient buildings, more efficient industry. So we have a lot of opportunities out there. It's just, Itron. Remember Itron? It's not just, when did we buy Itron? Well, if you've been with me long enough, you bought Silver Spring Networks, which Itron bought, and you made about five times your money on that in the last 5-6 years. So there's a lot of opportunities out there. You don't just have to think solar and batteries or EVs. It's the whole cleaning up of the energy sector. It's finding industry that uses this technology well. So technology is actually what's at the core of sustainability. If I already made clean energy cost competitive, in the very near future, once the manufacturing scale is there and the economies of scale start to take effect, clean energy is going to be cheaper than oil and gas and coal. And I'm not talking 10 years from now. I'm talking 2 or 3. This is one of those discussions where you have to try to figure out, is it 2 years away or 10 years away? It's probably closer to 2 than 10, which means that the market will start anticipating it again. So we've gotten the huge pullback in clean energy stocks. And while the rally was probably too much, the prices right now, I think, are pretty fair value. If they get cheaper, they'll be undervalued. So when we look at the big economic numbers, we notice that energy use kind of goes with gross domestic product, But because of more and more efficiencies, right, it isn't increasing as fast. So we can electrify the economy without needing more things to burn is really the answer. And because of efficiency, all these folks who talk about how are we going to power all these EVs, because there's trade-offs, what we see from this chart is that gross power production or consumption isn't really going to be that big of a challenge. Gross power consumption will probably double over the next 30 years, right? That's about a 2.5% growth rate on power consumption. It's just a shift. And it's a shift that's being impacted by much better technology. So while we might electrify almost everything, it's not going to be that big of a hurdle to jump because the technology is getting that good. So we want to focus on finding those technology companies that are powering this and the companies that are using the technology well to get ahead of their competitors. There will be some old man stocks and grandpa stocks that survive. And it'll be because they adjust. And the ones that adjust have great management and good balance sheets that will support the transition. And during transition, what happens? We get big corrections. So we don't want to just say, oh, it went down, I hate it. We want to say it went down, how come? And will it come back? And 4 out of 5 times, the answer is no, because turnarounds rarely turn. But 1 out of 5 times, you're going to be looking at 5 and 10 baggers. You can play those longer cycles, those 3, 4, 5-year position trades, right? A position trade is measured in quarters and years. Swing trades in days, weeks, and maybe months. But the position trades, those longer trades, ones where you say, look, this thing just gapped down and fell off, and then it started jitterbugging. Do I like the business? The answer is yes, right? 1 out of 5 times, the answers will be yes. How much should I put into it? What should I do with my asset allocation? Right? So these are the strongest trends in the economy right now, and they'll remain the strongest trends. And people can trade narratives any way they want in the short term, because in the short term, the market's just a popularity contest. But in the long term, it's a weighing machine. So if you're truly an investor who wants to buy and hold things for a while, get on these big trends. And there's some utilities you can buy, right? If you're a retiree, there's utilities you can buy. We've got a few on our list. And ultimately, this is all underpinned by the 4th Industrial Revolution. This is what Gartner calls it. I call it the smart everything world, right? 5G, IoT, and AI. One executive called that the perfect marriage. These are Ford's robots, by the way. So smart everything and 4th Industrial Revolution comes from all these things and how it's shared with good connectivity, low latency communication, artificial intelligence. So 5G, fiber, right? Why do you think I like AT&T? It's not just that they're doing a good spinoff. It's that 5G and fiber are a big deal. There are not a lot of companies that can do fiber. What kind of companies do you invest in then? Well, platform companies and as-a-service companies. And there's some overlap here because most of the platform companies are as-a-service companies, and most of the as-a-service companies have a platform. These are companies that are on our list. And I will tell you, we nailed Square and PayPal here in the last month, didn't we? Just nailed those bottoms. Now, will there be one more leg down? Yeah, but I think the bottoms are probably in unless the Fed actually makes that mistake, right? Because interest rates go up just a little bit. They both benefit. It's good for their business. Good for their business. I really like Square because of the Bitcoin. As I've said, I just don't see how Bitcoin doesn't go to 500,000, over the course of the decade. It's a store of value, and everybody has accepted that. The institutions and family offices are getting in. Bitcoin is the winner. They started out ahead, and nobody caught them. Now they're getting institutional and rich family adoption. It's a way for capital to be mobile. It's a way for somebody who's got millions of dollars or billions of dollars to say, I'm going to take enough, put it in Bitcoin in case I ever decide to go somewhere else on the planet. Maybe it's even the currency of space. I don't say that lightly. Elon Musk is working on the 3rd part of his big plan, by the way. I mentioned that right after I said space. Anyway, these are some of the smart companies that I've invested in over the years. There's more coming. By the way, Solar Edge just plunged because they did a stock offering. Might want to get into Solar Edge soon. We'll see. Right? Smart everything is where the money goes. This is a little bit outdated. Just mountains and mountains of cash, right? They're asset light and they generate big revenue. Look at this little company. Right? So I'm going to leave you with 2 sustainable smart everything world stocks. Ford got down when it was in the low 20s. I told you it was going to get down to around 16. It's around 16 now. SunPower, I told you it'd get down to around 14, 15, 16 when it was in the low 20s. It did. Now it's back up to 20. They are both great stocks for selling cash secured puts. If you're not doing that yet and you have a six-figure account, I'm not going to leave you behind here. I'm going to spend a lot of time on teaching how to sell cash secured puts. I know some people were worried that I wasn't doing that. No, the reality is that there's better times to sell puts and covered calls than other times. There's not a trade every week, but I will have an article up every week. And when there's no trades, I'll just teach you how to do something. And the Monday webinars will be in two parts, stocks of the week, and then retirement income options. I'll actually do two recordings because you know that I've updated my YouTube page, and I would really like anybody with a six-figure account or seven-figure account to learn how to sell options. It is a relatively safe way. It's safer than high yield stocks for sure, but you can sell calls and puts on companies that are way higher quality than those 7, 8, 9, 10% dividend stocks that everybody likes to brag about. If you can make 7, 8, 9, 10% selling options on a company like Apple or Google or something that's super strong, or you can take the lazy approach and buy high yield stocks of companies that aren't that secure, which one do you want to do? Take the time to learn how to sell covered calls and cash secured puts. All right. This is how you get a hold of me. If you want our special reports, the last couple special reports are on crypto. Just sign up for the free library card at Fundamental Trends. I have changed the name of it, but right, the special reports library. Find me here. I don't post a lot on Twitter, but if I do, it's usually a retweet of something that I thought was important, and I'll make a comment here and there. And then, of course, Investing 2020s on YouTube, which is still mostly free, but the trades we had to put behind a little teeny tiny paywall just to make sure that you had the advantage of getting those trades ahead of, freeloaders. And since there are sometimes a lot of people looking at my YouTube videos, I didn't want you to, have somebody else ruin the trade for you, because usually trades are only good for a few days. So $1.99 a month, if that's a lot for you and you're already a subscriber, honestly, I'll just give you a $24 a year discount on whatever you're subscribing to. I don't care. It's not about making money. It's about protecting the information. Somebody asked about some of our other stocks, so I'll just go through a couple that were asked about. Stone, I told you that Stone was bottoming out in the last couple of months. It just got upgraded, and it looks like Berkshire Hathaway might be interested again. So we'll see. If you don't own Stone and you want some emerging markets exposure, I think Stone is a great way to get into Brazil. I'm also looking at the Brazil ETF. So if you prefer an ETF, we'll be covering that imminently. What else? I think Jumia is going to get a good report the way Stone did. So if you haven't bought Jumia yet, you probably want to add a little speck of that again, or we can add FMQQ, which is the emerging markets technology fund. It's small. It's the right concept, but it's small. So I worry about that. I want things that are more liquid generally. What else did you ask about? Spire Global. Somebody asked about the warrants. There's nothing to do with the warrants. The warrants don't really kick in until the stock is in the teens. So nothing to do on most of these SPAC warrants. Somebody asked about one of the biotech stocks. I have a lot to talk about with biotech. The one stock that I think that you really need to own for a potential, the upside is just massive, is Heron Therapeutics. Heron Therapeutics just got some approvals in Canada. And I think that the push by the Biden administration to really crush opiates prescriptions I think it's going to take off big. So Heron Therapeutics is going to be one of the big winners there. And a lot of doctors I know, and one of my clients who knows a lot of doctors, weirdly, he's a fishing guide. So he just talks to doctors and, business people all the time. And he's got like multiple people talking to him about Heron Therapeutics. So Heron Therapeutics is a great one to sell puts on and take a starter position if you haven't already. I am probably going to make it a full position, a full 3 to 4% position. I have to see how my puts go, but I would expect that Heron Therapeutics is going to be one of my larger biotech and small cap holdings. And honestly, I'm looking at it like the same way I looked at Exact Sciences. I think this could make more than Exact Sciences, and that's the one that allowed me to semi-retire for a while, right? So take a look at it and do the search in the search bar. One last thing. Somebody who argues with me about oil made a comment and said, look, we're here for the analysis. And I understand that. And I have been stung a lot of times about my analysis getting stolen, which I don't like, because I have to protect the information because I still manage money for other people. And I don't want to say something that drives up a price before I've finished accumulating. So here's what I'm going to do. I am going to dribble out the information a little at a time like I've been doing. But then when we get close to our accumulation being done, or when I think a stock is bottomed, I will put out a full report, basically condensing all the information, and then you can have it all in one place. I will also use that article to send it over to Seeking Alpha Pro, which will go to the hedge funds first, and then it gets released to the public. So that's going to be the approach. I'm going to continue dribbling things in so that people can't just wholesale steal my analysis. I mean, Motley Fool has stolen my stuff and put it up almost verbatim. Motley Fool's getting away with it. You know what's happening. That's another reason I use the webinars. I know that some of you don't like the webinars, but you really should. It's a great source of information. It's another way for me to protect the analysis. And the reason I protect my analysis is because I definitively know, based on performance over a long period of time, that it's top 10% stuff. It might be top 2, 3, 4, 5% stuff. If you go to tip ranks and you strip out the ones that I said sell, just look at the buys, easily top 1%. Right? And remember, the things I say sell, it's based on relative performance. I wasn't shorting it. Sell this, buy that. And the buy that, taken on their own, have crushed 99% of the other guys out there. Crushed. Better record than Kathy Woods on her hot streak and overall. You just go to tip ranks and take a look at what I've recommended to buy. If you follow along with what I'm saying and you stick it out for a few years, you're going to start making a lot of money. I know some of you already have. When I get a chip on my shoulder, right, I haven't been motivated in a really long time, but I'm pretty motivated now. The last couple of years, I've gotten pretty motivated because I believe that climate change is real and I want to make a lot of money so I can get into the real estate development that I think is coming because of that. And I think a lot of people have a hazy view of what's coming and they're trying to find a way to capitalize on it as well as protect themselves. And I want to help you. I'm still a kid from an industrial neighborhood that went bad, right? I didn't grow up on the silk sock side of the tracks. It was overalls and blue jeans and t-shirts. And I think there's a big skim going on in the whole world from the fraction of 1%, not the whole 1%, but part of the top 1% that consolidates power and money. I know how that system works. I've been at the edges of it. I've had my face pressed up against the windows of the restaurants where they eat. I'm trying to bring you the information that I have, the experience that I have. And I will tell you, I'm not going to run around telling you that I was near the top of my class and I know this better than that guy. And I know this better than somebody else. I know better than you, like certain other analysts on certain websites. Well, I'll tell you, the track record is there. The process is there, largely borrowed, right? I didn't invent much, if anything. But I've learned how to use processes and approaches and experience and a good built-in bullshit detector and a little bit of a chip on my shoulder to do pretty well. The stocks on our list are really good stocks. Some of them are awesome. And honestly, you should just stick with the plug and play. The rest of the stuff on the VSL is for consideration. Those plug and plays, and you saw how I'm starting to do the weekly stocks of the week, right? I'm putting in a new chart. Make it really easy to follow. Updates and weekly price changes for our targets. You should be able to double or triple the market return, to be honest with you, over the next several years, because I don't think the market returns are going to be terribly high, but there are going to be parts that we talked about today of the market that do really, really well. So just remember, the market and the stocks within the market are different. The market is everything. The stocks you can pick. You can take a look at those 500 marbles in the S&P 500 and say, I want these 10. You can take a look at the Russell 2000 and say, I want these 10. And then I want some REITs and I want some of this and I want some of that. If you build a good asset allocation with 4, 5, 6 ETFs, depending on if you're doing sector funds, I guess, and 20 to 30 stocks, you should crush the market. If you add on 5, 6, 7, 8, 9, 10% extra income every year from selling options, oh my gosh. So I haven't made 25% for a while in a year. but that's my target. I would like to earn 25% a year on average. That means I'm going to have some 0 years and some negative years, but I'm also going to have some 40, 50, 60, 70% years. My best year was 90% in 2009. I would like to beat that. And I don't know what year it'll be, but I suspect it'll be before the next presidential election. How's that for a tease? I think the stocks in our basket right now are so good that the next time the market rallies, we're going to blow the doors off of things. So take a look at these lists. And if you have middle of the barbell stuff, get rid of it. Just get rid of it. Yeah, it might be okay. It might be pretty good. It might hurt something. Get rid of it anyway. The rest of this year is probably going to be choppy because at least in the short term, the Fed is tightening. And at some point, that ends. And if it ends in July or September, like I think, that means that the market is done going down by the end of the year. Because the big correction usually happens right after the Fed stops because usually the Fed overshoots. I don't think they will this time. I think they're just reloading the bazooka like I talked about. I don't know that they can ever take that bazooka off their shoulder. I really don't. Not until we're through the last baby boomer crisis, which hasn't happened yet. Happen later this decade probably. And then as we get into the 2030s, it might be a return to historical normalcy. We'll see. But between now and then, focus on those big trends that we keep talking about. And don't let the narratives screw you up. And understand that the Fed only wants to protect the dollar. Inflation and employment always balance themselves out. It's how markets work. Inflation and unemployment are just things that the Fed can use as it protects the dollar. That's it. That's all there is to it. All right. Have a fantastic rest of the weekend. Watch some NCAA. I don't know if anybody watched Wisconsin and Colgate last night, but man, was Colgate on fire. Wisconsin just squeaked it out at the end. Have any questions about stocks? Come on Monday. And we will we'll get a lot more done here in the next couple of weeks. I'm pretty refreshed from that vacation. I read a lot and talked a lot. I just didn't write a lot. Boy, do I have some stuff coming for you. All right. Have a good day.